Thank you very much, Connie. And again, a warm welcome to all participants in this session. It really is a pleasure to discuss with you today the topic of additionality, which is at the heart of the mission of multilateral development banks. My name is Sabine Bernabè. I'm the head of evaluation at the European Investment Bank, and today I will be both moderator and panelist for this session. I'm very pleased to introduce to you today the distinguished colleagues that are joining us for this session, Joe Eichenberger and José Carbajo as panel members, and as well as Andrew Kilpatrick, who will lead with the presentation. So let me introduce to you each of our distinguished panel members. Joe is the Chief Evaluator at the European Bank for Reconstruction and Development. He has extensive experience in emerging and developing markets, and through senior leadership and management roles in multiple multilateral development institutions, including EBRD, Asian Development Bank, African Development Bank, World Bank, and IFAD, as well as the US Treasury Department, he has built extensive experience with IFI operations, policies, strategies, and issues of institutional performance and delivery. Welcome, Joe. Our second panel member is José Carbajo. José is the Director for Financial, Private Sector, and Sustainable Development in the Independent Evaluation Group, IEG, of the World Bank. His expertise encompasses the appraisal of investment projects, infrastructure, public-private partnerships, IFI results frameworks, and project and policy evaluation, which he has gained through various positions in academia, IFIs, and consulting. So welcome, José. And before the panel discussion, of course, there will be an opening presentation by Andrew Kilpatrick. Andrew is an independent consultant who's been carrying out a stock take of MDBs approaches to additionality, which he will present some elements of today. He is an economist with a long career in academia and financial institutions, as well, including the UK Treasury and the EBRD, where he was executive counselor to the chief economist and secretary general, and director in the economics policy and governance department. So welcome, Andrew. So I think we have a really great panel to kick us off on this discussion of additionality and MDBs today. Just a few words before I'd like to outline the main takeaways of the session, but I think that from our collective experience in MDB, it is apparent that while the financial and development landscape has evolved since the establishment of our institutions, the mission to be additional remains the same. And as public banks, MDBs should really provide support to socially valuable projects for which the market doesn't provide sufficient financing because of market failures. So this is really at the heart of our mission and the topic of discussion today. So I will briefly outline the main takeaways of this session. So in this session, we will first of all look at approaches taken by a number of MDBs towards additionality. We will note, of course, that the financial and development landscape has changed considerably since additionality was first embedded in our founding charters. We'll consider a range of issues arising from how additionality is assessed by MDB management, operational, and evaluation teams. We will raise some matters for evaluators to consider. And finally, the panel interventions will share experiences from evaluating additionality in different institutions. So before I pass the floor to Andrew, I would just like to remind you to use the Q&A chat box to pose your questions, which the panel and Andrew will also address after the panel discussion. And that's it. So without further ado, I'd like to pass the floor to Andrew for his presentation. Andrew, the floor is yours.
Okay, good morning, good afternoon, everybody. Thank you for being present online. The slide in front of you shows you the 5 areas that I will cover in this presentation. And I will start right away with a bit of background before talking about additionality, trends, some issues facing evaluators, and some final remarks. So if I can have the next slide, please, Connie. Thank you. Okay, so the background to the work that I've been doing is part of what I want to discuss now. But the starting point is that additionality has been part of MDB's modus operandi for a long time, though I think it has been somewhat neglected, at least until recently. Now, shareholder interest has increased as efforts have redoubled to leverage the private sector alongside public institutions to meet the SDGs. And so, for example, in 2017, under the Italian presidency of the G7, there was a call on MDBs to look at additionality, which resulted in joint work towards the harmonized approach. And recently, the OECD DAC has started to look at the issue. Now, the background to this particular work I've been doing follows a meeting last year of the ECG, which discussed the idea of a stocktake of MDB practices, looking at operations, management, and evaluation approaches to additionality, with a view to helping evaluators understanding of the current state of play and where to focus attention. So today, I'm going to present some interim views on this. Next slide, please. This just shows you very quickly the MDBs and DFIs that have been involved in this study. 6 multilateral institutions, as you can see, and 4 DFIs. I won't go into any detail, you can see them on the screen. Let's go to the next slide, and we'll turn now to the concept of additionality. I think one of the issues that confronts us is that additionality is not an easy concept to apply. Now, simply put, it describes something that would not otherwise have occurred, but ascertaining the counterfactual is already conjecture, not fact, and most markets in which the MDBs work are poorly served, with alternative finance options difficult to discover. When MDBs invest alongside commercial players, additionality is generally seen, as you can see in this quotation on the slide, as a contribution beyond what is available in the market, and that it should not crowd out the private sector. Now, I think it's worth noting the phrase contribution beyond what's available in the market here, and that some organizations, notably those who provide grants, focus in a different way on additional outcomes or development additionality. But for most MDBs, development outcomes are looked at under project results frameworks or development impact, while additionality is the unique value added by the MDB to the project itself. And so the last quote on this slide shows that the key inputs that make the project happen or do so to make it go faster or better than otherwise, including improvements to its design. So there is a bit of a different focus here in relation to some organizations, but MDBs look at the input side primarily. Perplexing as the concept is, MDB additionality matters for a number of reasons. For one thing, the more the private sector can deliver, the better, and MDB should not get in the way of this. They should help the private sector do more, as well as extend the MDB's own reach. And additionality is a route to ensuring this. MDBs not only aim to avoid crowding out the private sector, they also add value. This is seen through increasing the availability of long-term funds, leveraging commercial and other finance for development, tackling market gaps by taking on more risks than the commercial sector, and improving the quality of operations in various non-financial ways. Additionality supports value for money and ultimately the taxpayers' interests and private sector development, and it can create incentives to innovate financially and push into new areas. Properly applied, it helps MDBs select relevant projects and encourages better project design. And of course, good evaluation improves MDB effectiveness as lessons are learned about contributions which work well and those which do not. Next slide, please. So additionality is a valuable tool, is a guiding tool for MDBs. However, additionality is far from easy to evaluate. Take financial additionality, which is conceptually hard to determine. It cannot be observed directly and depends on market circumstances at the time, almost impossible to assess 5+ years later. Evidence depends on project leaders' judgments, provision of comparative market information where it's available, and indirectly on subsequent events such as waivers, prepayments, and cancellations. Direct mobilization of finance, which is one part of this financial additionality, is an exception, but here attribution and definitional issues arise. And while non-financial contributions are in principle easier to assess, evaluation is hampered by a lack of clear expectations of value added, poor monitoring of their implementation, and few benchmarks. Unexpected contributions can be included, but to do that, they need documenting, which is not always the case. So successful evaluation needs good preconditions. But before looking at that, let's consider some broader trends and challenges. The next slide, please. My point here is to note that the mandates of MDBs, which for all major players includes a clause on additionality, have not fundamentally differed or changed over many decades. On the slide, you see the quotations from, for example, the IFC, shall not undertake any financing where there is sufficient private capital. Now, while the same cannot be truly said of interpretations of additionality, the basic instruction of don't get in the way of other reasonable finance that's available is present throughout this long period. So from IFC in 1956 to the AIIB almost 60 years later, which I chose just because it's the most recent MDB on the scene, but it replicates the ADB as it happens on this point, the mantra is the same. One could call this, I guess, a do no harm or don't get in the way approach. But finance, next slide please, has certainly changed. So the same cannot be said of commercial finance, which has evolved dramatically over this period. Not only has finance grown faster than economic growth, but the range of financial instruments and the number of institutions supplying financial products has increased enormously. To take some examples, private credit by deposit banks as a percentage of GDP has more than doubled in Brazil, China, India, Mexico, and South Africa since 1990, the year in which the EBRD, one of the institutions I'm looking at, was born. And even faster in Nigeria, the Philippines, Thailand, and others. Liquidity has soared since the financial crisis, and just for comparative purposes, it's worth reflecting that JP Morgan Chase's balance sheet is 4 times the size of the World Bank Group. In the same period, many poorer nations have risen to become middle or upper middle income countries and have become much more financially sophisticated. Again, it's worth reflecting that today, 4 Chinese banks are the largest in the world, with total assets far in excess of their nearest Japanese, US, UK, and French counterparts. At the same time, the number of MDBs has increased from a handful in the early days to some 25 or so today, with a large increase in financing capacity, along with a rising supply of donor funds and concessional finance, and philanthropic, impact, ESG funds are also growing fast. So the conclusion here is that the finance space MDBs inhabited some years ago is now a crowded one. MDB plain vanilla financial additionality no longer stands out. And indeed, the non-public sector is catching up elsewhere too. Next slide, please. Yet financial additionality remains important, especially to many shareholders. The challenge is to be able to test it robustly to find areas of deeper, more clear-cut financial additionality. Doing so can lead MDBs towards less developed financial markets, e.g. in weak and fragile states, where finance is genuinely needed, and towards high-risk reward solutions such as innovative finance and cutting-edge financial instruments. A strong focus on financial additionality also poses tough questions on MDB presence in more advanced markets and on when to let go. Now, management accept these arguments in principle, but many economies where additionality is strong are small and risky, with poor business environments, and they involve resource costs. which militate against other objectives, notably business volumes and reliable returns. Next slide, please. The squeeze on traditional financial additionality has coincided with two trends, in my view. One, an increase in the use of blended finance, a combination of conventional and concessional finance to reach riskier areas where market gaps are greater. And two, a shift towards non-financial additionality, where MDBs have some comparative advantages. I will focus on this aspect here for the moment, and blended finance we can talk about later. So MDBs definitely contribute valuable inputs in non-financial ways, for example, through political risk cover, through knowledge transfer, innovation and expertise, capacity building, support via technical assistance and trust funds, improving standards, playing an honest broker role between the state and the private sector, and in policy and regulatory change. But most of these additionalities only emerge as projects get underway. So the evaluation challenge is to have a reliable, to use a modern phrase, test, track and trace system in place that allows assessment and attribution of this additionality. Now I want to turn to some issues facing evaluators. So there are 6 slides here, as you can see, covering these areas. I may not go into full detail, we can talk about it later, but let's start with the first slide on clarity and coherence. So of the MDBs I've been looking at, despite differences in their objectives, where, for example, the EIB focuses mainly on European Union member states, or the GEF on the environment, all see additionality as important and as a requirement to be met. And they all have systems in place to assess additionality. So in principle, everything looks on the face of it as if it's there and in place. But additionality is nonetheless the poorer relation of development impact, and MDB practices are a bit varied. More than anything, it is hard to find a coherent story about additionality anywhere across these institutions. And the question of whether additionality deserves more prominence may be one that's worth discussing. The next point is that there is no single consistent definition of additionality, but fortunately the concept of contribution beyond the market is common ground now for most, and the recent MDB harmonized framework, which I mentioned earlier, has been influential in helping MDBs line up typologies and sources of additionality. Now, in this context, MDBs consider the quality of their contributions to the operations they perform in one way or another, and they look at the difference their inputs make in the context of the theory of change, with an expectation that their contribution assists development outcomes. One of the interesting things I found is that integrated systems of additionality and development impact assessment exist, but most MDBs deal with the components separately. And sometimes the line between the two, that is between additionality and impact, becomes blurred and confusing. I think a comprehensive umbrella could be considered as a way of tackling this problem. Next slide. Strategic issues. Now, while key MDB documents, strategic and capital reviews, annual reports, and so on, may mention additionality, they generally offer little strategic depth on the issue. Additionality is almost entirely seen at project level, but options exist that go beyond this. For example, a greater strategic focus could be achieved through analysis of MDB additionality over time, or within sectors, within countries, or between countries, and among financial instruments and client types. A higher level basis for understanding additionality, which could point out where efforts might be targeted, could come from more comprehensive information, for example, on market gaps, contemporaneous financing conditions, related market data, repositories, local, environmental, social and governance and other standards, areas approaching graduation from MDB assistance, and more specifically, MDB comparative advantages. Portfolio assessments too might be considered alongside individual projects. A more strategic approach as well could help with resourcing matters. So a proportionate or targeted approach based on likely additionality might be able to free up resources to focus on the more contentious areas of additionality. I turn to operational judgments now. Assessment of ex-ante additionality is one of the most difficult tasks for evaluators. Judgments are mainly made by investment officers ahead of board approvals, and they can be hard to fathom where little evidence or clear reasoning is provided, which, unfortunately, is more often the case than it should be. There are some approaches which try to get around this. One is using ex-ante rating systems, which specify in some detail what counts and how to scale additionality components. A counterpart, if you like, to those rating systems that are used by all of you evaluators in ex-post cases. Now, ex-ante rating systems can help bankers' understanding and choices, and they can carry through to the ex-post evaluation phase. But at the same time, they may feel a bit rigid or mechanical, and rating systems have their own pluses and minuses, and incentives and all that follow with those. Another approach that may help is the use of quasi-independent reviewers. Where this happens, it's usually a bunch of economists who are integrated into the decision-making process, but they are giving a view a step away from those who are conducting the direct transactions. And this could help evaluators later on, especially on financial additionality, to have an insight into what the thinking was from a semi-independent. They aren't completely independent, of course, because they would be involved in the operations, but they are slightly to one side, and that may be able to help evaluators get a fix on financial additionality, which, as I said, is quite hard to do. Other routes offer detailed guidance on what to look for under additionality, supplemented by model examples. There's some good cases of this, and I think clear practical guidance on sound ex-ante practices looks to be a relatively easy step forward for everyone. Next slide, thank you. There are a number of areas which are ambiguous in the world of additionality. The first of these is mobilization of additional finance. Now, this forms part of financial additionality and is an increasingly important part of MDB business. Indeed, there are many MDBs now who are targeting mobilization as a strategic goal. Yet differences in definition and interpretation exist. It's very hard to get a common view across MDBs on this aspect. A second point is repeat clients, which occur quite frequently in many MDB cases, and repeat projects for that matter too, which don't seem to be treated consistently. Here there's a need to articulate how additionality is served by the developing relationship. When several MDBs finance the same project, there is no mechanism to ensure additionality assessments are made on a consistent basis. A further point is that additionality through improvements in standards, for example, environmental and safety standards, are subject to different interpretations. Sometimes they're seen as a regular compliance item, as per the loan agreements. Sometimes they're seen as being part of driving local norms forward. And finally, where financial advantage is incorporated as additionality, it may result in windfall effects and distortions of the playing field. And similar difficult issues arise here with blended finance. Let's turn to monitoring and reporting. I guess successful evaluation of additionality depends on well-prepared baselines and counterfactuals, good data, clear articulation of intentions and implementation paths, and evidence of delivery. When it comes to the practice, though, there is considerable variation in quality. For example, over the specification of additionality sources ex ante, the quality of supporting evidence, counterfactual assessments, delineation of expected effects, use of indicators, benchmarks, and timings. Evaluators could take a systematic approach in cataloging performance in these areas. In particular, monitoring of additionality claims is generally weak. It's patchy and it's uncoordinated. And this is matched by minimal collective in-flight project reporting. So an area of focus could be additionality monitoring and reporting systems, including their governance, coordination with other areas such as technical assistance, data handling, and IT arrangements. Another issue is transparency. Now, there is some here in annual reporting or summary information before board approvals, but it could be enhanced. In fact, there are bits and pieces across different MDBs, which, if you add them all together, comprise quite a decent degree of transparency, but they aren't anywhere unified, if you like. So, in my view, public disclosure is valuable. It supports feedback. It helps with potential interest in the lessons that are derived from evaluations as well. While additionality is partly covered in evaluations of project clusters, programs, sectors, that sort of thing, actual evaluations of additionality itself have been sparse, at least until recently. And I'm glad to say more are now planned for the future. So one more set of issues before I conclude. And this concerns trade-offs and tensions within the world of additionality, shall we say. One very clear message you get from operational staff is that additionality assessment can be a burden. Well, that's understandable, of course, but as I mentioned earlier, it may be possible to optimize resource use by looking more carefully at where to pay most attention. Additionality is part of the project decision-making process, and there may be a trade-off here between additionality and profitability or business volume, but this is not really completely clear. The question, and I've raised in red here on the slide, as you can see, some issues to consider, is how concerning such a trade-off might be for evaluators, and maybe a portfolio approach could be, is it a reasonable solution? Something similar arises in the question of non-financial additionality, where there is no definitive view on whether it's sufficient for a project to go ahead. So a question is what view one might take of a project that has strong expected development outcomes, for example, but may at the same time crowd out some private finance. Is that verboten, or is that something to be considered? And if so, how? Additionality is also, in this context, measured against commercial sector alternatives. But in some cases, another MDB may be the relevant alternative. How might this be addressed, for instance? In some institutions, additionality is not applied to public sector projects, even though similar principles apply, and private finance might be an option. So the question is whether a unified or more consistent approach to public and private sector additionality deserves consideration. And importantly, increasing use of concessional and blended finance blurs additionality, as do explicit and implicit subsidies elsewhere. Does analysis of additionality need to be extended to cope with these issues? We may hear more about that in a moment. But let me close my remarks with a couple of further points. Sustainable development requires the transfer of human capital as well as financial capital. Climate change goals, better governance, gender equality, they rely on behavioral, institutional, and regulatory change as well as finance. And here, MDBs have comparative advantages. Hence, MDB additionality is both finance and knowledge-based. MDBs add value by carefully selecting, designing, and strengthening projects through, for example, appropriate finance and structuring, mobilizing other funding, implementing quality standards, and by working closely with clients as they execute their plans. And policy engagement around projects adds further value. These efforts and the inputs involved are more than do no harm, they also do some good. Additionality is not simply yes or no. Some form of finance is usually available in the market, but is always less attractive than a long tenor, low cost loan. So what's of central interest, in my view, is the overall value of the MDB's contribution, i.e. the difference it makes. An MDB's contribution beyond the alternatives to a project provides the counterpoint to development results and helps make clear what additionality means today. So let me finish by considering how evaluators might respond to additionality issues. Greater consistency in approach to additionality is possible, in my view, across MDBs without loss, from which all would benefit, management, evaluators, and the public alike. How might evaluators respond? Well, in addressing additionality, evaluators could look for integrated systems, proper specification of key additionality sources, why they're needed, what would happen without them, clearer statements of expectations, use of supportive evidence, effective monitoring of implementation, explicit reviews of delivery performance, and greater transparency. Common definitions of sources of additionality, use of agreed indicators and benchmarks, and consistent levels of ambition on standards and so forth would assist evaluation, while common databases for financial market information would be in every MDB's interest. So let me end there, and thank you very much for listening.
Thank you very much, Andrew, for this very interesting, extremely rich and comprehensive presentation, which really highlighted the central role that additionality plays for MDBs and the associated challenges we face in defining, measuring, and reporting on it. I think you've really raised some very important questions which provide food for thought, and I think a very good basis for our discussion today. So I think I'll move on to opening the floor for the panel discussion, and I'll ask the panelists to react or elaborate on some of the issues raised by Andrew's presentation and focus on how they apply to their institutions. After that, as I was previously mentioning, we'll open the floor for Q&A, and I would like to remind you once again to please post your questions in the Q&A chat box, and they will be passed on to us. And I would also like to ask the panelists to try to keep their responses to 4 minutes if possible. So now I think I'd like to focus on one particular point that was highlighted in Andrew's presentation, and it was the fact that his review identified many complexities around defining additionalities. He found that several definitions have been used over time and across the MDBs. However, MDBs have come together in a common high-level definition of additionality for private sector intervention. And there's broad agreement on 2 categories, financial and non-financial additionality. But as we have seen, the way they're treated really differs across institutions. So I would like to ask you, Joe, since the EBRD's focus is on private sector transaction, it really gives it some unique perspectives on the definition of additionality, the financial and non-financial aspects, how they're reflected in projects, and what success may look like. So I would like to ask if you could share some insights of your work on this.
Thank you very much, Sabine. Can you hear me?
Yes, we can hear you.
Good, good. Well, thank you. I want to thank Sabine and Andrew, and also the ECG for allowing Andrew to present an early look at some very important work that's still in progress. I have to say, I think Andrew's presentation is really a model of clarity and breadth and insight, and it feels to me on this very challenging issue of additionality, I've seen little, frankly, that is as comprehensive and useful as what we just heard and saw. You could do a lot worse than that, and it's against that background, a very comprehensive presentation from Andrew. I just thought I'd make a few observations about additionality from the particular perspective of EBRD. My understanding is we may have an opportunity to have a second round of comments, allowing us to go into specific issues in more detail, and I'm happy to do so. But at EBRD, additionality specifically is uniquely for EBRD. It's one of 3 key operating principles that have been built into the basic purpose of the organization, and they are that every transaction EBRD does must be sound banking. It's a bank. Secondly, it needs to have transition impact or development impact, and third, it needs to be additional. And so the point that Andrew made, that additionality is a feature across the MDB system, is certainly true. For EBRD, it actually has a particular characteristic in that it's this core operating principle. It's central to the bank's institutional mandate and purpose, but interestingly, it had never been evaluated. We in the evaluation department did a first such evaluation in 2018, and I wanted to just summarize a few of the main findings. Although the main points have already been covered in Andrew's presentation. But a few of the main findings are, first, at EBRD, there was a very early focus on financial additionality. That is, the expectation was, the wake of the fall of the Soviet Union, EBRD would bringing its own finance and leveraging other finance to places where financing wouldn't otherwise flow. It was relatively straightforward. The deal teams understood it, and the bank was seen as being very effective. But over time, we found the concept, as Andrew identified, the concept of additionality expanded. It expanded to include almost any impact that the bank could have on the existence or the design or the funding of projects. And this then was the whole sphere of non-financial additionality. And in fact, these non-financial additionalities, as Andrew identified, became at EBRD a principal claim. So areas of policy dialogue, standards, technology, partnerships, etc. But again, as we've seen already, neither concept was ever really adequately defined, not financial additionality nor non-financial additionality. And from this flowed no clear guidelines, no benchmarks, no monitoring, no reporting. So from an evaluator's perspective, but more importantly, from the perspective of the shareholders of the bank, there became no basis for either establishing ex-ante standards as to what would be accomplished, or for ex-post assessment of whether it actually was accomplished. And as Andrew pointed out, the line between additionality, which is an input, and transition impact or development outcomes, which is a result, became extremely blurred. So 25 years after the founding of EBRD, one of the conclusions of our evaluation that one of its core institutional mandates, one of three core institutional mandates, had really no strategy, no definitions, had no clear institutional home where people were responsible, and provided very limited basis for evaluation and learning. Now, this is not to minimize the very real challenges around this conceptually and operationally that Andrew presented, because they are real. So the EVD paper, the evaluation, got very close attention from the board and management. The management's task force was produced, was called, that produced some substantial improvement on operational matters, which I think were helpful, including to the transaction teams. And broadly, it included so-called triggers for when projects would require a closer discussion of additionality. This would be where, for example, they were repeat transactions, or where the deal was very heavy on refinancing or on working capital. And this is a step forward. But as for having a basic clarity on basic conceptual issues, the bank is not much further along. So these were some of the principal findings of our evaluation. I think it has triggered an ongoing and very substantive conversation inside the bank, but as Andrew indicated, there's still a long way to go, not just inside EBRD, but also across the institutional system. I'll stop there. Thanks, Sabine.
Thank you, Joe. Sorry, I was having some trouble with my mic. Thank you very much for sharing your experience at the EBRD and the findings from your evaluation. These mainly, of course, EBRD operates in more developed transition markets, and I think it would be interesting to complement this discussion with the experience from less developed financial markets. So as we know, in the current context of ample liquidity in global markets, there's possibly higher potential for additionality in high-risk, weak, fragile states that have less developed financial markets and where finance is desperately needed but scarce. So perhaps I can ask you, José, to tell us about your experience with evaluating additionality, particularly in the context of fragile states.
Thank you, Sabine, and thank you, Joe and Andrew, for an excellent presentation. And thank you also for the organizers and our colleagues and counterparts in the Asian Development Bank. Indeed, I think that the evaluating additionality, fragile and conflict, even violence context is quite tricky. I think what it helps us is bring and put on the table the concept of risk and heightened risk and how risk gets allocated, because that is supportive oftentimes of the motivation behind the additionality of IFIs. We recently carried out in IAG a synthesis of available evidence on the experience of IFC over the last 10 years. And this is what I want to share with you, the main findings and the lessons from it. We all know that fragility, conflict, and violence, as I said, situations pose a major challenge for development. And the private sector is called to play an important role, but it faces substantial constraints in those circumstances. This perhaps explains why one of the findings is that the IFC's investment volume in FCS has been modest and has been just about, over the last 10 years, 4.5% of its total new commitments and 7.5% of the number of new projects. So it is not particularly the challenge, therefore, from the point of view of additionality and the point of view of the business model of the IFC is how to scale up this. I mean, it's understood that the portfolio is diversified across countries, and more important, the advisory services. Advisory services are 3 times in relative terms, in percentage terms, compared with investment, which means that advisory services are a very important channel for IFIs, in this case, the particular case of the IFC, to affect additionality. So findings of our assessment that helped assess the additionality of IFC, success rates, for example, evaluated IFC investments, and that's a percentage of about half of the entire portfolio, in FCS perform very similarly to those in non-FCS countries. So we have 54% of projects in FCS countries are rated mostly successful or above in terms of development outcome, compared with 58% in non-FCS. So that's good news. I mean, these results indicate that it is feasible to achieve non-financial additionality in FCS context. The range of development outcomes. Now, evaluated investments, again, based on our evaluative evidence, have a range of positive development outcomes in FCS host countries, again, supporting exposed non-financial additionality. And this is from increased employment to income earning opportunities to helping local businesses and the generation of government revenues. Size of investment, this is important because it provides a counterbalance. Stronger results in FCS were associated with larger investment size and larger economies. Now, these are characteristics that are not necessarily common across all the FCS countries, and therefore this may influence the additionality of IFC intervention in FCS. Another one, client quality. The quality of IFC clients in FCS is strong. And again, this is supporting the positive development outcomes. However, you have to consider what are the trade-offs there. If you concentrate on a stronger client, it also may reflect a certain degree of risk aversion to work with new types of clients, which is what you want to do in order to buttress, to strengthen your additionality. Last but not least, the cost of doing business. This is well known. Cost of doing business in FCS is higher than in non-FCS. And this is something that needs to be bear in mind when you assess the financial additionality as well. Now, having said that, these are the main findings. I want to just 3 takeaways. I'd like to highlight 3 takeaways that are at the center of the dialogue in terms of the additionality of IFC in FCS countries. One is the interaction between additionality and business models in the IFC. So adapting IFC's business model, instrument mix, and risk tolerances to FCS countries is a challenge. And this is necessary in order for, to as it were, affect additionality and to face or to respond to the needs of the private sector in such sectors. And by the way, I didn't mention at the beginning, to fulfill the objectives and the scale-up promises that IFC has made to the board as a consequence of the capital package that was approved a year ago or so. So first is the interaction between additionality and business models and the need to as it were, be more creative in terms of risk tolerance. Second is additionality and client types. As I was mentioning before, the range of potential private clients, both external and local, that IFC works with in FCS countries, suggests different pathways to increasing business in FCS and to affect the non-financial additionality. For example, IFC can have high additionality when it is working with the smaller domestic sponsors or existing clients investing in an FCS country that is not the traditional one. In other words, moving from one FCS country to another. So that's something to bear in mind. In some cases, however, the additionality may be more limited, where an established client may have been able to attract similar financing from commercial sources. And we observe certain dynamics there, in the sense that the IFC helps a new client to come into a sector or into a country and then move to more risky on their own. Third, and very important, something that perhaps we will be able to, I mentioned it already, and Andrew has mentioned it already in terms of knowledge, additionality, is the additionality and advisory services, the links between the two. This is linked to the ability and the risk appetite of different clients. And given the low capacity of business environment in many FCS, advisory service many times, oftentimes bridge the gap, as it were, cover the risk that private investors are not willing to take. And this advisory service may take many forms in order to, as I said, buttress or enhance the capacity of the sponsors. This is a particular feature when using blended finance structures, a topic that we may have the opportunity to talk about later on. So, concluding, in some investment in FCS, IFC has showed high additionality, while in others this is a bit more questionable. So there is a little bit of as it were, the mixed picture that evolves from this synthesis report. Now we are in the midst of doing a more in-depth evaluation of both IFC and MIGA in FCS countries in order to support the strategy that the World Bank will be having in those countries. So, although projects in FCS reflect high risk, you can argue they also represent valid risks for IFC to take on, as projects otherwise would not have attracted term finance in those fragile contexts. So, I think all in all, the main bottom line message, based on our experience and on the work that we are undertaking, is that the evaluator needs to be aware of these distinctive features, client size, role of advisory, range of outcomes, etc. And they have to be aware of this distinctive feature when assessing the underlying counterfactual, as Andrew was saying, which involve in assessing the additionality of IFIs in FCS, in fragile and contested countries. I hope this provides food for thought. There is available in the ID website the synthesis report that I am referring to, and even the approach paper of the evaluation that we are currently undertaking to support. I'll stop here. Back to you, Sabine.
Thank you very much, Jose, and thank you for a very good overview of the work that you're doing on the additionality in fragile states and the question of risk. I think this link between additionality and risk is a very interesting question, and often the rationale for an MDB to intervene is indeed that the private sector is not willing to take the risk required to finance some socially valuable projects. And this is certainly the case in fragile states, as you were highlighting, but I think it's also an issue in more developed markets, in particular areas or sectors where financing is still scarce. And maybe I can say a few words about this later, even in the European Union context, so very advanced economies. But the idea is that by taking this additional risk, the MDB is able then to mobilize private capital towards financing socially valuable projects that would not get otherwise financed. I think this is the basic idea. So perhaps actually we can focus on this question of private sector capital mobilization. And I'd like to ask you, Joe, whether you could share your experience with additionality and the question of mobilization of private capital in the context of the EBRD.
Thank you, Sabine. Can you hear me? I lost the connection for a while. Am I?
Yes. Yeah, we can hear you and see you well.
Okay. Well, thank you. Thank you very much. Just a few points here. I think again, the comments have encapsulated, I think, very well that the additionality challenge, as broadly understood, is very consequential one, and it's a very substantial one. There are technical issues, there are operational issues, but most importantly, it seems to me, what's emerging from this work is that it has very, very concrete implications for all of the MDBs and the IFIs, operationally, strategically, and the like. And we think it's very important, very worthwhile to focus on the single issue of mobilization, because at some level it's at the core of how we understand the role of these institutions, whether they're poverty focused or market building focused or otherwise. It is the mobilization of additional finance that is really at the heart of the argument in favor of these institutions, and it's the basis for the ongoing expectation of public support. I think it's also the case that it's really now, it's much more clearly understood, this point that this is at the heart of how MDB contributions need to be understood. So, for example, the global commitments, global long-term commitments that have been made in respect of the SDGs and climate objectives are fundamentally built on a recognition that vastly greater amounts of private finance are necessary to close the gaps and meet the goals that have been set. And there is a recognition now, again, unlike the early days of the MDBs, as Andrew pointed out, when they actually had a substantial portion or could lay claim to a substantial portion of the capital flowing. Now it's little more than a drop in the bucket. And those goals encapsulate an expectation of more private finance. Also, the MDBs collectively made an explicit commitment to make more intensive use of their balance sheets in order to mobilize additional private finance. So these are serious and basic commitments. We did an evaluation at EBRD looking closely at how mobilization was understood inside EBRD, and what, if anything, could we say about mobilization. In the process of doing that, we also looked with some care at the treatment of mobilization elsewhere in the system, and I think came up with some pretty interesting and important findings. By the way, both of these studies that I've referred to here, this study on mobilization and the previous study on additionality, are available in full on the EBRD's website, and I encourage interested people to look at them. The broad findings of the of our study on mobilization again echo some of the points that Andrew made. First, there's, generally speaking, there's a lack of clarity and consistency in definitions across the IFI system, between the IFIs and the OECD, and the bilateral agencies, etc. There is, generally speaking, a kind of a conflation of public and private funds. As Jose mentioned, and Andrew also mentioned, this whole issue of blended finance has very much complexified our ability to have a clear line of sight into what private finance is actually being stimulated. There's a basic question, which is, you know, if EBRD collaborates with IFC in doing a project and it invites some additional finance from FMO, is that mobilization when these are all public sector players? I think there's a very fair argument could be made that it may be some kind of mobilization, but it doesn't help us understand the private sector piece. There's an ongoing debate in the IFI community and the OECD about how to define blended. It illustrates the differences, but there's no resolution, and there needs to be resolution. Our evaluation suggested that the available data, and again, Andrew's point about the difficulty of getting clarity on data is a very real one. But the available data that we have suggest that the institutional system as a whole is actually having a very low level of mobilization of private funds. There's a very substantial amount of work to be done here, as with additionality, in improving definitions, improving the use of institutional benchmarking, establishing targets, etc. In EBRD in particular, our evaluation found, again, the data are generally very poor. There are all sorts of institutional incentives and disincentives that tend to get in the way of mobilizing additional external private finance. In these organizations, it tends to be preferred to use the organization's own capital. We find generally there's very substantial room on the balance sheet at EBRD to leverage up its ability to trigger additional private capital. And we think that there is a very strong case for much more creative thinking, and we think this is Jose's point about risk, preparedness to take greater risk with new products such as guarantees and insurance to develop unexploited sources of private sector finance. There is also a necessity to build in benchmarking more clearly into scorecards. Our sense is, why couldn't the EBRD have some sort of multi-year target in terms of its mobilization of private finance? In any event, the evaluation, I think, has stimulated an interesting, important, and I think forward-looking conversation in EBRD. And it's one that we as evaluators, I think, can contribute to substantially. And I think presentations like this have already begun to do that. So thank you, Sabine.
Thank you, Joe. Thank you for another very interesting intervention and raising a lot of very important questions. Maybe one specific aspect that you raised, which I think we could explore further, is the link between new products, innovative products, cutting-edge financial instruments, and the mobilization of private capital. And the fact that particularly in a time of ample liquidity, plain vanilla MDB financial products are no longer necessarily additional. And I think a number of our evaluations have found that, in fact, there are specific instruments. You were talking about guarantees, securitization, equity, quasi-equity, and so on. And of course, also blended finance and the use of grants, that these provide more additionality and are able to mobilize more private sector finance. So maybe I can ask you, José, to follow up on this question of blended finance. I understand that IEG has done some recent work on blended finance. And I was wondering if you could elaborate on the challenges for evaluators when assessing the additionality in the presence of blended finance structures.
With pleasure, Sabine, thank you. And this links up, complements well the context that Joe was referring to. We know that many private sector projects have the potential to generate positive impacts, but these impacts, unfortunately, not always can be achieved because of the risk being perceived too high. So what is the link between this and the additionality of MDBs? Well, precisely the additionality of MDBs is motivated to a large extent by the ability to address those risks that are related to the executing the project, or external risks such as climate-related disaster risk or political economic instability. Risk also associated with the uncertainty of the market, with the projects where the private sector is operating. So altogether, blended finance is one of many, but one tool that has received enhanced attention recently to mitigate the risk and facilitate those risks and facilitate this financing for private sector-led projects. As probably you all know, but it's worth reiterating, blended finance combines concessional financing on the one hand, that is to say loans, for example, that are extended or more generous than market loans, and commercial funding. So a priori, that already is a vehicle to add additionality. Now, evaluators, as you were asking, Sabine, face certain challenges when assessing additionality in blended finance structure, and this relates to several issues. And then I will first list those issues quickly and then give you a summary of the findings of an exercise that we did deep diving in 5 projects, what we call a cluster project performance report. So the issues that evaluators face is first to identify risks and their adjustment. Blended finance is in principle designed for IFIs to work with riskier projects. We all know that. But that means a relatively higher hurdle rate for commercial performance to assess the commercial performance of this project, not the standard one. But may also need to adjust, as an evaluator, you need to adjust the dynamics, the time frame whereby you assess the effects of an intervention. Number 2 is the fact that the subsidies play a crucial role. And therefore, from the point of view of additionality, you need to have a strong evidence to justify the existence and the provision of that subsidies for the institution. What are the incentives that are generated by the presence of the subsidy? And also, what are the dynamics in terms of the life cycle? I mean, do you need the subsidy on a regular basis, or as the principle of subsidy usage in blended finance suggests, you have to as it were, phase it out? Another challenge is for evaluators is the multiplicity of interventions. And this goes back to the comment I was making before about the presence of technical advice. Technical assistance oftentimes, if not always, accompanies blended finance operations. And the challenges for evaluators are, okay, to what extent is this technical cooperation or assistance justified, or addressing the specific needs or to mitigate certain risk? Did the donors providing the technical cooperation funds, bring a specific knowledge that is relevant to the project or not? That's another area for evaluators. And then last but not least, something that it always gets, pushed to the right-hand side of the theory of change is the impact on beneficiaries. There is a lot of attention and focus put when evaluating blended finance on the financing structure. What risks are being transferred a priori, how risks are being mitigated, what is the market failure, at least potentially being addressed. But there is not enough understanding of how the blended finance arrangement is having an impact on the end beneficiary, which is, when you think about it, the original motivation. So that's, in general, based on our experience. Now, very quickly, I'm going to run through, if I may, the main findings from a recent report that we published. And as I was saying before, this is available in the IAE website. And it's called IFC's Blended Finance Operations Findings from a Cluster of Project Performance Assessment Reports. And what this report does is synthesize evaluation findings from an experience of with early blended finance projects approved recently between 2012 and 2016. Number 1 finding, main finding, a blended finance instrument has helped set in motion high-risk projects, such as greenfield projects, building operations from the ground up, projects in untested markets, etc. So that's good news, and that justifies there is a direct subsidy of about 2 to 5% of IFC project costs, and the IFC blended finance catalyzed the transaction for high risk. So that's good news. And as I said, this is based on a very specific ground-up, limited sample, but it's a common theme. The project design, second finding, in most of these projects ensure that the benefits of the subsidy were passed along to the ultimate beneficiaries. This is the point I was trying to, this included, for example, there were a number of 5 projects. If you want, we can discuss them later, but affordable leasing for rural farmers, or affordable housing for other rural tenants. So the case studies show, at least in terms of the background work that we did, that the subsidy yielded economic benefits which significantly exceeded the cost of the subsidy. Those are good news. However, in most cases, this is another finding, technical assistance and advisory services, forgive me, I'm a little bit of a broken record here because this is an important dimension, were critical, was a critical element. Blended finance, from that point of view, was able to de-risk some of the financial risk, but not all the non-financial risk. And therefore, there was the need to have this this points to the importance of the role of advisory services, which can reduce a specific non-financial risk, while at the same time be a conduit, be a channel for non-financial additionality. And this is really the three main findings. One is that the blended finance instrument helped set in motion high-risk projects. The subsidies were justified, at least in the sample that we looked, but that there was not a full de-risking of the project. Some risks remain. Last but not least, combining the challenges of the evaluators, the original of your question, with the findings, accounting for the total financial subsidy provided to a project is challenging. This is again, I just want to emphasize, if I were to summarize the challenges for evaluators with the findings, this would be for me the one key area where we have to develop more work to understand better from a methodological point of view, and some of the questions that I have seen in the chat are already pointing out to that. You know, in other words, how do you assess risk and the value added of and the additionality and the value added of these blended finance projects? So the risking activities are costly. They often have high administrative costs. So as a result, IFC financial returns may be below expectations in some cases. And this is an area where we need to do, as it were, further research. But I think I want to emphasize again, just as a concluding comment, the importance of bringing evidence from the bottom up. I think that there are a number of us who are looking at additionality concerns and working on the additionality space, the OECD, DAC, EvalNet, for example, trying to develop principles. I think that methodological and clarification of principles and definition needs to be complemented with evidence from the ground up. And I encourage you to read this report. Sorry that I extended myself a little bit more, but I think this is important. Over to you, Sabine. Thank you.
Thank you. Thanks very much, Jose. No worries. I think your intervention was very interesting, and it was very interesting to hear about this work that you've been doing on additionality in the context of blended finance. And I couldn't agree with you more that it's important to bring evidence from the bottom up into our thinking on definitions and measurement of additionality. Let me just summarize a little bit, very briefly, discussion so far, and maybe make take off my hat as moderator and put on my hat as panelist and make a little brief intervention on the EIB side. So I think we've discussed a lot in a number of different contexts, the question of risk and private sector mobilization, and also financial and non-financial additionality, and these issues of clarity and coherence in definitions and the challenges in measurement. And I'd just like to share our experience with the evaluation of a specific instrument called the European Fund for Strategic Investments, FC. Some of you may have heard of it. It was a very large scale instrument as part of the investment plan for Europe to basically stimulate growth and economic recovery in Europe. And I think this experience complements well our discussion, also because we were assessing the additionality of an instrument rather than of specific projects, which is one of the points that Andrew mentioned. And indeed, we were almost assessing the additionality of the entire institution, because FC makes up a very significant part of EIB's activity in Europe. So as a brief background, FC was basically introduced in the aftermath of the global financial and sovereign debt crises. And as a result of these crises, investment in Europe had declined significantly. And the feeling was that there was an increase in risk aversion from the private sector. So the private sector was not willing to take risk. And so the idea was that the EU budget would provide a guarantee to the EIB to increase the risk-bearing capacity of the EIB, so that the EIB would invest in projects and take risks that the private sector wouldn't take, and thereby mobilize private financing into socially valuable projects that would address market failures and thereby stimulate growth and employment. So this was the grand idea, and is the grand idea of FC. And so in fact, essentially, the objective of EFSI was to be additional. So EFSI had two requirements, two layers of requirements in terms of additionality. On the one hand, it was supposed to finance projects that could not be financed by the market, so it was additional by to the market. And on the other hand, it was to finance projects that the EIB itself would not have been able to finance with its own resources because of the risk element. So when we evaluated the extent of additionality of this entire instrument, and I'd like to just highlight 3 points that I think are interesting for our discussion today. First, the issue of establishing a credible counterfactual that Andrew mentioned. So when we were asking ourselves to what extent EFSI allowed financing projects that would not have received the same financial and non-financial inputs, we were faced very quickly with the difficulty in establishing an objective counterfactual. So some kind of control group of similar projects that did not receive EFSI financing. We couldn't do that, and so the best option we had was to rely on self-reporting. So we carried out a large-scale survey of EFSI beneficiaries, and we asked them, what would have happened in the absence of the EIB or the EFSI support. This approach obviously has some weaknesses because the responses are likely to be biased. So this issue of counterfactual is very important. Another related issue that Andrew quickly mentioned, but I think is very important, is the fact that additionality is not simply a yes/no question. It's not, what we found with this evaluation, that it wasn't whether the projects would have been financed or would not have been financed, were financed or would not have been financed without EFSI. Often projects would have found financing without EFSI, but the question is, would the financing would have been for a smaller amount or at a later date or at different conditions, which all would have affected the timing and the scale and the scope and the quality of the project. So we thought that when assessing additionality, it was really important to take a nuanced approach and to look at all these different aspects and not ask a simple black and white question. A second point, very brief, that I'd like to highlight, which is something that Andrew also highlighted in his presentation, is that our evaluation really brought to the light the risk of trade-offs between volume targets and additionality. And I think this is a reality for all our institutions, and it's particularly relevant now in the context of mobilizing finance for SDGs and climate targets. When you have these volume targets, and at the same time you have the requirement to be additional, there can be some kind of trade-off and perverse incentives. And our evaluation found that because of this, EFSI was supposed to mobilize 315 billion euros of additional investment within 3 years. This pushed our operational colleagues to really focus on the volumes, perhaps at the expense of additionality, which in the end is what really mattered for the objective of EFSI, which was to create additional growth. So unless you're additional, you're not going to create additional growth. And finally, very, very briefly, because I see that we are running out of time and I'd like to give space to the questions, is the question of mobilization and of private capital and the challenge of attribution. So as I was saying, EFSI had this strong mobilization objective. It was supposed to mobilize 315 billion euros of investment. And when we tried to assess the extent to which this was the case, we were of course faced with the question, who mobilizes who? Was it the EIB that was mobilizing the other investors? Or perhaps was it the other way around and the EIB was just filling a gap and coming in at the end and the other investors had mobilized the EIB? And of course, this is a question of attribution. It was very difficult. We had to do a project by project assessment, but this was certainly one of the challenges we faced, and I think Andrew rightly highlighted. So in view of the time, let me stop here, and I would like to open the floor to questions from the participants. I see that we've received a number of questions. If you could just give me a few minutes. Okay, so what I'd like to do is, we've received a lot of questions. I'm very happy to see that there's a lot of interest in this discussion. I will select a few and put them to all the panelists. So the first question from the audience is, MDBs through their private sector operations cannot displace the market. Hence, financial additionality is implicit. Should financial additionality be a limitless test and be independently verified at approval? Non-financial additionality can probably be better assessed with the proper ex-ante design. Let me hand over to you, Joe first, and then we'll move on to the other panelists. If you would like to respond to this.
Okay, thanks, Sabine, and whoever it was, thank you for the question. Yeah, it goes to the heart of it. I think in Andrew's presentation, I think he tried to address some of that. I would say, generally speaking, there is more than we can do at the front end, at the transaction specific level, and with respect to the use of different instruments. There's more we can do at the front end to satisfy ourselves, maybe at a higher level of rigor, about whether we are actually being financially additional. As Andrew said, there are real issues about the counterfactual, the quality of information, etc. So it's never going to be a full science. But I think our view is we certainly could do more. And I think it's entirely positive that the level of attention to this issue now, it feels to me, having been around the system for many years, the level of attention to this critical issue is higher than it's ever been. Let me just make one point and I'll stop, and that is, I think behind some of our difficulty here, frankly, is we may be making some assumptions that are not entirely justified. And that is, how do we know when we're dealing with market failure or with policy failure? We sort of have a default setting that we say, well, when worthy people can't get finance, it must be market failure. But it's clearly not always true. And the fact that, and as Jose, I think the findings allude to this, the fact that you can have very specific application of blended finance that's specifically intended to reduce risk against the assumption that the market has failed adequately to do that. We see many, many cases of that. And when the blended finance runs out, the transaction is done. So it only went because it was made financially more attractive. So there's something else happening there. And it feels to me like there's an element here that we are not adequately capturing the differences between policy failure and market failure. I'll stop there.
Thank you, Joe. Very interesting point, and I couldn't agree more. I think also that higher risk does not always imply a market failure. Projects can simply be very risky because they shouldn't be financed and they're not actually addressing a public good or socially valuable. They're not adding any value to society. But let me pass that on to Jose. Would you like to complement?
Very quickly, I would suggest to move away from the concept or the notion that we have, that there is a mechanical way or a definitional way in which, just the presence of an IFI means that, the financial additionality is given. I think the story is much more nuanced than that. In the past, as Joe was saying, perhaps the financial additionality was an exercise in looking at certain features of the financing instrument, the tenor, the interest rate, the subsidy element. But the more we are bringing non-financial additionality aspects, as Andrew has mentioned, into the picture, the more the assessment is nuanced and therefore requires nuance, and therefore you need to look at several criteria. So, and then to make matters more complicated, I just want to share an anecdote that I experienced in the in the second half of the 1990s when I was working at the EBRD, and that is that the behavior of the IFI itself can create a curious trade-off in which the additionality may be misconstrued. I'll give you the example. I recall when the market in the Russian Federation, well before the crisis and well before the EBRD decided to cut activity. In other words, at the height of Russian Federation being the main client or the largest concentration of portfolio of the EBRD, second half of the 90s, early 2000s, the market caught hold of the fact that when EBRD was approaching a regional bank in the Russian Federation, that was a good sign. So as a consequence, obviously, these things, you do your due diligence in a private, prudent way. But the minute that the market gets information on that, the interest heightens. So that this was the paradox. By the time there was, let's say, an initial public offering of this regional bank, which the EBRD has expressed an interest, it was already oversubscribed, which meant that the EBRD had been quite additional in terms of working out and helping this institution, but the market had read and was overcoming. So this is just an example of the complexities and the dynamics that are involved. So additionality is not just a static thing whereby you use your better judgment to assess it ex ante, and then after the project is complete. There are many things involved in that. And of course, the teams that went to the operations committee to argue the additionality case had a lot of points to say, because, thanks to their due diligence and to their good market savvy research, they had identified the proper bank to invest. And, but the market has read it. So maybe it's an extreme example, but it's a complex one, but it shows what I wanted to say, that it shows the complexity and the dynamic nature of additionality. I'll stop here.
Thank you. Thank you very much, José. Andrew, would you like to comment, say something about this question? Andrew?
Can you hear me?
Yes, now. Yes,
okay, so well, briefly, thank you, Sabine, and thank you to the person who asked the question. I think there was a comment about the non-financial additionality aspects, which might be easier to manage, and I think that's right. I think the difficult one is financial additionality, and maybe more can be done at the front end, as Joe said here, but it's inevitably a tricky business. The information you need is market information, and to get that information you need to be close to the market. And of course the bankers involved, some of the economists who are working on transaction will be very close to what's happening day by day in the market. But whereas evaluators are further away, I mean, they could spend time getting more involved, but then there's the issue of, is it worthwhile, and does it compromise their independence in due course? So somehow more information needs to be extracted, but exactly how is not entirely clear to me. One issue that's becoming more prominent in some MDBs, I think, where this is particularly acute, is the question of support to debt market capital transactions, bond issues, which of course only happen at the instant of the auction. So how do you know that the MDB is going to be additional? And often you see oversubscriptions to some of these issues. So there's a real challenge in that area. There are some possible solutions to it, but I won't go into that now. But just to bear in mind, there are a number of different instruments that this causes some difficulty with. One thing to bear in mind, though, that makes life a little easier in some respects, is that it's important to think about the market and differentiate between types of markets. So in situations, let's say in Tajikistan, there's not going to be a big issue about financial additionality in the same way that there is, let's say, in operating in more advanced markets, like in Poland, for instance. So as I mentioned earlier, it's worthwhile considering where to push hard to get the better information. And in the more advanced markets, there is market information. It may cost money to buy the relevant databases and so forth, but that's another issue. But there is information that can be obtained there. But it isn't worth spending a lot of time in less developed markets trying to finesse the financial additionality aspect. But maybe I should stop there, as we're running short of time and there are other questions, I know.
Thank you, Andrew. Thank you very much. We are running short of time. We have 5 minutes left. I think we have time for one more question with a very quick round of reactions from the panel, and then I can say a few concluding remarks to wrap up. There's a question, obviously, about the COVID-19 crisis. And now with the COVID-19 crisis disrupting the economic context, what are the likely implications for MDBs additionality? Joe, would you like to say a few words about that?
Yeah, I'm not sure what I can say about that other than that. I mean, my sense is the default setting across the system will be never let a good crisis go to waste. And I think the institutions are true to form. EBRD has responded very rapidly to pressure from shareholders to ramp up its involvement, but that has meant doing more of what it's familiar with doing and doing more of what's easiest to do, which is doing sort of plain, as Andrew said, plain vanilla structured finance on its own balance sheet. I do think that it will be important, crisis or non-crisis, that we somehow find ways to keep attention on the potentially very high value of institutional innovation, new instruments, finding new ways to power up the balance sheet, because the world has changed and the MDBs are never going to be more than a drop in the bucket relative to private finance. Warren Buffett alone woke up this morning sitting on $150 billion of cash that he's trying to invest somewhere. Institutional investors all over the planet are sitting on billions, trillions that they need to invest. Feels to me that the big value added is in somehow recognizing that there's a space here for these institutions not being occupied now, crisis or not. Thanks.
Thanks, Joe. Jose?
Very quickly, 2 words, potential and risk. I think that what COVID has done is to enhance, to make it more acute, the potential for IFI additionality, because now we have to cover higher risk. We have to reinforce the support to fragile and conflict situations, as you were saying. And the COVID-19 crisis is having an impact, a more severe impact in certain countries that are the weaker. So all of this provides potentially a higher role and motivation for the additionality. The risk comes from the side of not only developing new instruments, as Joe was suggesting, but the risk comes from lowering the guard. In other words, in order to disperse quickly and reach the market that you want, you try to forget about the rationale behind the subsidies that, for example, support blended finance or other additionality, other instruments whereby the additionality is affected. That would be, so you can do more, you can expand the markets, but you have to be mindful not to use this as an excuse to reduce, as it were, the rationale and the discipline that is involved in the financial additionality aspects related to a structure such as blended finance, where subsidy elements are present. Thank you.
Thank you very much, Jose. I think with that, I'm going to have to start to bring this session to a close. Thank you very much for all the questions. Unfortunately, we were not able to address them in the time, but it shows that this is definitely a very interesting topic, that there's a lot of interest in it, and that the discussion has to continue. I'd like to thank all the participants for participating, and especially our panel for the very interesting discussion. I think that we've seen that despite the challenges that we've discussed, there is definitely a clear consensus that MDBs must strive to be additional. The economic, political, and financial context is changing and will continue to evolve, and so will our understanding of additionality. And as evaluators, we will have to adapt our evaluation approaches and methods. And in particular, we'll have to help our institutions to refine how additionality is defined and provide insights into how it can be better assessed and monitored. And that this needs to be done not only at the individual project level, but also for entire instruments, especially now in the context of the COVID-19 crisis. So with this, I would like to conclude exactly at 12:30. It's really been a pleasure discussing with you, and in particular, to hear your views, Andrew, Joe, and José. Many, many thanks. And thanks again to all the participants who joined the session. And a big thanks to the Asia Evaluation Week team for their excellent work in organizing this fully virtual conference this year, which is really very impressive. So thanks to all, and goodbye. Hope to meet sometime in person.
And thanks to you, Sabine, for moderating so well.
Thank you very much. Yep. And Andrew, fantastic presentation.